Let's go ahead and talk about revenue recognition. In particular, let's talk about long-term contracts. Now, if we are engaged in a long-term project of some sort, we may wish to recognize revenues prior to their actually being earned in the usual sense. Now, usually we say revenues are earned when we've completed our side of the contract. If we have a 4-year contract to build a boat, we haven't fully earned the revenues until we deliver the boat. That means that for the first 3 years we'd have 0 revenues, and since expenses are matched against revenues, we'd also have 0 expenses. So for the first 3 years, 0 revenues, 0 expenses. 0 revenues, 0 expenses, 0 revenues, 0 expenses. Finally, in the 4th year, when the boat is completed and delivered, we'd recognize all the revenues and expenses all at once. Clearly, that doesn't accurately reflect the earnings process. In the case of long-term contracts, we can, under certain circumstances, recognize revenues and expenses as we do the work. Now let's go ahead and start with an example. Let's say we're going to enter into a 3-year contract to build a bridge. The contract price is $1.2 million, and it's going to be billed and paid in 3 equal annual installments of $400,000 each, and it's expected to cost a total of $1 million to build the bridge. And let's have the following data regarding costs. Okay, so in the first year, 2001, we spend $300,000, and we expect to spend another $700,000 in the future for an expected total cost of $1 million. And the billings and collections will be $400,000. Again, we're going to take that $1.2 million and bill it and collect it in 3 equal annual installments. In 2002, we spend another $400,000, so we're now up to a cumulative total of $700,000. We expect to spend another $300,000 for a total of $1 million, and again, we bill and collect another $400,000. Finally, in the 3rd year, we spend another $300,000. We're done, so there are no expected future costs. And the actual total cost comes in at $1 million, and again, we bill and collect another $400,000. Okay, so there's our example again. Now, completely independent of the question of revenue and expense recognition, we have to record the transactions that are actually occurring. We're spending money and consuming resources to build the bridge, we're sending a bill to the client, and we're collecting cash from the client. So first, to record the spending of the money, the incurring of costs, we credit cash, materials, overhead, labor control, wages payable, things like that for $300,000, and we're essentially building inventory. Now in cost accounting, you'd call this work in process. We're going to call this construction in process, but it's exactly the same idea. It's an inventory of a product that's under construction. Next, we send the client their annual bill for $400,000. We debit accounts receivable for $400,000, and instead of crediting revenues, we're going to credit this thing called billings on construction in process, which is in the same vein essentially as an unearned revenue account. And finally, we collect from the client, and we record a cash collection like we would record any other cash collection. We debit cash and credit accounts receivable. Now, note that nowhere in the entries on the previous page were the words revenues or expenses mentioned. When we spent the money, we were creating inventory. When we billed the client, we were recording that as essentially unearned revenue. The recognition of revenues and expenses is a completely separate issue. Now, there are 2 methods we can use for revenues and expenses. The one we're going to talk about first is what's referred to as the completed contract method. Under the completed contract method, we wait until the contract has been completed and recognize the revenues and expenses all at that time. So this method is less desirable since it doesn't allow us to recognize revenues and expenses as we do the work. Now, under the completed contract method, we're going to accumulate the costs of production in that inventory-like account, construction in process, and at the same time, as we bill the client, we're going to accumulate those costs in the billings on construction in process, which is similar to unearned revenue. When the contract is completed, we're going to close the construction in process to essentially cost of goods sold, cost of long-term contract, and we're going to now close the billings on construction in process to contract revenue. Basically, the unearned revenue becomes revenue, the inventory becomes cost of goods sold. So let's go ahead and continue this example. In 2002, we have our 3 entries. We record the incurrence of the various costs, adding to that inventory account. We bill the client for another $400,000, and we collect the $400,000. 2003, we do the same thing. We spend another $300,000 building and completing this project. We send the client his third and final bill for $400,000, and the client sends us the third and final payment of $400,000. Again, after 3 years, the construction and process account has a balance of $1 million. That's the total costs that we have debited to that account over the 3-year building process, while the billings and construction process has a balance of $1.2 million, the contract price. So we're going to close the construction and process to cost of goods sold, and we're going to go ahead and close the unearned revenue, the billings on construction and process, to revenue. So there's where our inventory becomes cost of goods sold essentially, and there's where our unearned revenues become contract revenues. Now the second method, and the one we're going to spend most of our time focusing on, is referred to as the percentage of completion method. Under this method, we're going to recognize revenues and expenses in proportion to the amount of work that we've done. In other words, in proportion to the percentage of completion of the job. Now the amount of work done is generally going to be measured based on how much money we've spent. Of the total costs, what percentage of the costs have been incurred so far? If we've spent 25% of the expected total cost, then we're 25% of the way done. Let's go ahead and expand the table we had before to include information to help us determine the percentage of completion. Now, this is the same data as before. I've simply added a few columns. A few rows. I've added the row costs to date, or sometimes referred to as cumulative costs to date. That's a running tally of how much we've spent. So in 2001, we spent $300,000 for a cumulative total of $300,000. In 2002, we spent another $400,000, so our cumulative total is up to $700,000. In 2003, we spent $300,000, so our cumulative total is up to $1 million. We then below that have our expected costs to finish, or expected future costs, and below that we have our expected total cost. The expected total cost is simply what we've spent so far plus what we expect to spend in the future. So in 2001, the costs to date are $300,000, the expected future costs are $700,000, for an expected total of $1 million. For 2002, the costs to date are $700,000, for an expected future cost of $300,000, for an expected total of $1 million. And finally in 2003, the costs to date are $1 million, no expected future cost, so the total cost is expected to be $1 million. The percentage complete, or the percentage of completion, is how much we've spent so far divided by the expected total. So in 2001, we've spent $300,000 so far out of an expected $1 million total, so we're 30% of the way done. In 2002, we've now spent a cumulative total of $700,000 divided by an expected total of $1 million, so we've spent $700,000 out of $1 million, or 70% of the total, so we're 70% of the way done. In 2003, we're done, so we're obviously 100% of the way done. And that final row, the billings and collections, that's the exact same as it was in the previous example. And there's our table again. Okay, now under the percentage of completion method, in addition to the 3 entries to record the spending of the money, the billing of the client, and the collection of the cash, we're also going to need an annual entry to recognize a portion of the revenues and the expenses. And again, we want to recognize the revenues and expenses in proportion to the work that we've done that year. Now, how do we know how much revenue to recognize? Now, first we're going to do this the long, formal textbook way, and then we'll look into some shortcuts that we can take. Now, this is very important. What we're doing in this set of slides assumes that the contract has been and is expected to be profitable overall. In this case, the contract price is $1.2 million. The expected total costs are $1 million, so we think this contract is going to make us a $200,000 profit. Now the revenues will be calculated as the percentage complete times the expected total revenue minus any revenues previously recognized. So in 2001, that's going to be 30% times the contract price of $1.2 million. Since this is the first year, we haven't recognized any revenues before, so minus 0 equals $360,000. Similarly, for expenses, it'll be the percentage complete times the expected total cost minus expenses previously recognized. So 30%, the expected total cost is $1 million, so 30% of $1 million minus 0, because no costs have been previously recognized, for expenses of $300,000. So we'll go ahead and record $360,000 of revenues, $300,000 of expenses, cost of long-term contract, cost of goods sold, something to that effect. And so those two accounts together will go to our income statement. Revenues 360 minus expenses 300, gross profit 60,000. For purposes of a journal entry, the difference, whether it's a debit or credit, in this case a debit, we're simply going to put into construction in process. Okay, year 2. Again, we still expect the contract to be profitable overall, so we're going to use that formula again. For revenues, it's the percentage complete times the expected total revenues minus any revenues previously recognized. So now we're 70% complete times the 1.2 million of expected total revenues. Last year we recognized 360,000, so we subtract that out and say, okay, now we need to recognize an additional 480,000. Likewise for expenses, the percentage complete times the expected total costs minus the expenses previously recognized. So 70% complete times $1 million, the expected total, minus the $300,000 we recognized last year means $400,000 of expenses. So again, we credit revenues from long-term contract for 480. We debit cost of long-term contract for 400. The difference we again put into construction in process. Finally, in year 3, and again the contract is still expected to be profitable. For revenues, we're now 100% complete times 1.2 million, and we've previously recognized a total of $840,000 in revenues. 360,000 the first year, 480,000 the second year. So 100% times 1.2 million minus 840,000 equals $360,000 of revenues. Likewise for expenses, we're 100% complete. The expected total cost is $1 million. We've already recognized $700,000 of expenses, so that means we'd need to recognize an additional $300,000. So there's our revenues, 360, expenses or cost of long-term contract, 300. The difference again goes into construction in process. Now, after doing this for 3 years, where do we stand as far as construction in process and billings on construction in process are concerned? Billings on construction in process has the total contract price. Again, every time we billed the client, we credited billings on construction in process. So 3 years at $400,000 a year is 1.2 million, and that's the total contract revenues. Construction in process has both the actual cost, because every year as we spent money or incurred costs, we debited construction in process. 300,000 the first year, plus 400,000 the second year, plus 300,000 the third year, plus we've been debiting that account for the profit recognized in each of the 3 years. 60,000 the first year, 80,000 the second year, 60,000 the third year. So the total balance in construction in process is therefore 1 million, that's the total cost, plus 200,000, the profit we've recognized over the previous 3 years, equals 1.2 million, or essentially cost plus profit, which by definition equals revenues. Again, that's sort of an accounting identity. Revenues equals cost plus profit, or revenues minus cost equals profit, or rearrange it any way you please. Since we've already recognized the revenues and expenses and therefore the income over the previous 3 years, at this point we're going to simply close construction in process with a balance of 1.2 million against the billings on construction in process with a balance of 1.2 million, and we're done. Seems straightforward enough at this point. So what are the shortcuts that we might use? First, let's talk about the revenues. Let's see what we did back in the second year for revenues. At that point we were 70% complete, so we took 70% of 1.2 million minus the revenues previously recognized, 360,000. Now where did that 360,000 come from? That was the previous year's percentage of completion, 30% times the expected total revenues of 1.2 million. So let's go ahead and factor out the 1.2 million, and we've got 1.2 million times 0.7 minus 0.3, or 1.2 million times 0.4. And basically 0.4 is the increase in the percentage completion from 30% in 01 to 70% in 02. So basically what we're saying is that we've gone from being 30% complete to 70% complete. Again, looking down at the next to last row in that table. So we did 40% of the work this year, so we're going to go ahead and recognize 40% of the $1.2 million in revenues. Now note that this only works if the total contract price is constant from year to year. In this case, the contract price was fixed at $1.2 million. That's why we could factor out the $1.2 million. If the contract price changes, and a lot of times in contracting, if there are cost overruns, the cost overruns get shared partially with the customer, especially in government contracting. And so the contract price isn't fixed, and so you can't factor out that 1.2 because it's changing. But as long as the contract price is fixed, we can simply say the revenues to recognize in any given year are equal to the total revenues multiplied by the change in the degree of completion, or the percentage completion. So from 2001 to 2002, we're doing 40% of the work, going from 30 to 70%. From 2002 to 2003, in going from 70% complete to 100% complete, we're doing 30% of the work. So we'd recognize 30% of the 1.2 million. Likewise for the expenses. And again, I can't stress strongly enough, as long as the contract is profitable overall, which is the case here, the expense for the current period is simply equal to the spending in the current period. In this contract, the contract never became a money loser overall due to cost overruns, so every year the cost of long-term contract, or the expense for the period, was equal to whatever we spent that year. $300,000 in year 1, $400,000 in year 2, $300,000 in year 3. We'll explore what happens in the case of an overall loss in the next set of slides.